So now that we have talked about both the fair value method and the equity method, I want to talk about maybe 3 additional points just to wrap up this class. So first of all, you may have wondered, why can't we just use the fair value method when investor has significant influence? Or in other words, why do we need to use the equity method instead of the fair value method? Please, I'm going to let you think about it for a minute. Please pause your video for now. Okay, so why can't we just use the fair value method when investor has significant influence over investee? This is because when investor has significant influence over the investee, what can investor influence? It can potentially influence investee's dividend policy, right? So what can possibly happen in this situation? And if the investor is using the fair value method, it can recognize investee's dividend as its own dividend income. And then if investor can influence investee's dividend policy, what can investor do? Investor can potentially manipulate its own investment revenue, which is dividend income, by influence the amount of dividend paid by the investee, right? So this can be a potential way for investor to manipulate his own earnings. And this cannot be allowed. So we are using, so that's one reason we're using the equity method in this situation, when investor has significant influence over the investee. So if you recall that under the equity method, when investee is reporting dividend, we do not record it as income. Instead, we record it as a decrease in investor's investment account. So although equity method help us to avoid this potential way for investor to manipulate its own earnings, there are also criticisms of the equity method. And then one of the criticism is the overemphasis on position of 20 to 50% of voting stock in deciding on significant influence or control. So as you may remember that, how do we, well, FASB's voting stock ownership guideline for deciding whether investor has significant influence over investee or control is if investor has between 20 to 50% ownership in the investee, this will indicate investor has significant influence. But sometimes firm may actually control other firms with less than 50% of the voting share. So this can happen in a lot of the situations. And what are the consequences if consolidation is used when one firm controls another firm? So in this situation, when one firm controls another firm, we should use consolidation in this situation. But if we just use the 20 to 50% rule, we may just use the equity method. So what are the consequences if we do not use consolidation in this situation? And then the consequence is, there are several consequences. It may allow off-balance sheet financing, potential manipulation of performance ratios. So it can open up some other doors for manipulation. And then lastly, let's look at there's something called fair value option. Let's just talk very briefly about the fair value option. So fair value option is basically the company, it gives the company a choice. The company can choose the fair value option. And if the company chooses this option, the securities are recorded using the fair value method. But one thing to pay attention here is, so fair value option is made for each individual security and is irrevocable. So once the firm chooses the fair value option, it cannot revoke it. And then, and also the firm may choose fair value option only at specific time. So it cannot just decide at any time, or I'm going to choose the fair value option and I'm going to change to the fair value method. Fair value option gives the firm the option to just use the fair value method instead of the equity method. But firm cannot, once the firm chooses it, it cannot revoke it, and also it can only choose it at specific time. And specifically, what does fair value option allow the firm to do? So fair value option is just use the fair value method instead of the equity method. So specifically, if the firm chooses the fair value option, it's just the difference between fair value and the equity method. It doesn't need to amortize excess cost because this is only what we do under the equity method. No need to adjust earning for intra-entity inventory transfer. This is what we do only under the equity method. Dividend from investee reported as earnings. So this is what we do under the fair value method. Report investment fair value as an asset and change in fair value as earnings. So we need to adjust for we need to do the fair value adjustment. So those are the specifically what we need to do under the fair value if the firm chooses the fair value option. And then lastly, let's just, so this last slide is about consolidation. Consolidation is basically one company. We haven't talked about it so far, but we're going to spend the rest of this semester talk about consolidation. So just in this slide, I'm just going to give a one slide overview of consolidation. It is one company may control another firm. So consolidation, when do we use consolidation? That is when investor has control over investee. And when can it happen? It can either happen through ownership of voting stock. It can also happen through some special purpose entity, special contractual arrangement, or various interests. And for the accounting treatment, we take the investor's balance sheet, all of investors' balance sheet, income statement, statement of cash flow, and the investees' whole set of financial record, and then to combine those together. So to form a single set of financial statement for external reporting purpose with all asset, liability, revenue, expense from both the investor. So once we do consolidation, investors are called parent and investees are called subsidiary. From both the parent and subsidiary brought together. So we're going to spend the rest of this semester talk about consolidation, but this is just one slide overview of consolidation. And this is all for today's class.